Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Agnc Investment Corp. Annual Report. Agnc Investment Corp. offers a range of businesses and services that cater to the housing market in the United States. The company's primary focus is on investing in residential mortgage pass-through securities and collateralized mortgage obligations. These investments are guaranteed by government-sponsored enterprises or government agencies, providing a level of security for investors. One of the key benefits of Agnc Investment Corp's business model is its tax-efficient structure. As a real estate investment trust, REIT, the company qualifies for federal income tax purposes, which means it would not be subject to corporate income taxes if it distributes at least 90% of its taxable income to stockholders. In summary, Agnc Investment Corp. provides private capital to the housing market through investments in residential mortgage-backed securities and collateralized mortgage obligations, with a focus on government-guaranteed assets. The stock price of Agnc Investment Corp. has experienced a significant increase of over 24.3% in the past year, with its total stock return reaching 34.8%, with dividends reinvested for the full year of 2025. This substantial growth was driven by several key factors and news events. Agnc reported an exceptional year for shareholders in 2025, achieving an economic return on tangible common equity of 22.7% and a total stock return of 34.8%, with dividends reinvested. The company's strong performance was attributed to the best-performing domestic fixed-income asset class in the fourth quarter of 2025, which generated an 8.6% total return for the year. A favorable interest rate environment also contributed to Agnc success. The conclusion of the Federal Reserve's tightening cycle and expectations of lower interest rates in 2026 created a constructive investment environment. Lower interest rates generally lead to a revaluation of MBS portfolios, benefiting MREITs like Agnc. In addition, improved market conditions, including lower uncertainty and increased housing affordability, also contributed to the favorable market conditions for Agency MBS. Agenc's active management strategy, which included expanding its asset portfolio and reducing leverage, enhanced its performance and risk management. The company saw a robust rebound in its book value, with tangible net book value per share increasing by 7.2% in the fourth quarter of 2025 to $8.88. Agnc also reported significant growth in its net interest income, which increased by 79% year-over-year in the fourth quarter of 2025. Management expressed optimism for 2026, anticipating another strong year due to continued lower interest rates and a balanced supply and demand outlook for Agency RMBS. The potential for further Federal Reserve rate cuts and government actions to bolster the mortgage market also fueled this positive outlook. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for a company are multifaceted and can be attributed to various factors. Firstly, interest earned on investments is a significant contributor to revenue growth. Additionally, TBA dollar roll transactions, Agency RMBS acquisition, leverage, and dollar roll income from forward purchases of agency securities also play a crucial role in driving revenue upwards. Lower short-term interest rates and greater accommodation by the Federal Reserve can also have a positive impact on revenue growth. On the other hand, the primary drivers of revenue decline are net realized losses on investment activities, hedging costs, principal and interest payments from agency RMBS and multifamily MBS, credit risk transfer (CRT) securities, gains and losses on U.S. Treasury securities and futures contracts, and realized gains or losses on interest rate swaption agreements. These factors can have a significant impact on a company's revenue growth or decline, making it essential to understand the underlying drivers of these changes. By analyzing these factors, companies can make informed decisions to mitigate potential risks and capitalize on opportunities for growth. The net income of the company underwent significant fluctuations between 2023 and 2025. Initially, it decreased from $155 million in 2023 to $863 million in 2024, a staggering increase of 453%. However, this trend was short-lived, as the net income surged further by 93% in 2025, reaching $1,670 million. The profit margins also experienced a decline over the same period. In 2023, the net income to revenue ratio was not available due to lack of data. However, it dropped to 3% in 2024 and further decreased to 7% in 2025. The reasons behind these changes are multifaceted. Potential investment losses from delinquency and foreclosure of mortgage loans, increased risk of loss on CRT securities and non-agency RMBS, credit spreads widened, reduced market liquidity, and increased costs of financing investments for longer periods all contributed to the decline in profit margins. These factors collectively impacted the company's financial condition and profitability. The company's financial performance indicates a consistent trend of generating positive operating cash flow. The data from 2024 shows a net cash provided by operating activities of $86 million, which increases to $653 million in 2025. This significant improvement suggests that the company is efficiently managing its operations and generating sufficient cash to cover its expenses. The operating cash flow status is explicitly stated as positive on page 74, further confirming this trend. Additionally, an analysis of the company's balance sheet reveals a notable increase in total assets, $15,407 million, accompanied by a decrease in total liabilities, minus $231 million. This indicates that the company is generating positive operating cash flow, which is being utilized to grow its assets and reduce its liabilities. Overall, the evidence suggests that the company is successfully generating positive operating cash flow, which is a crucial indicator of its financial health and stability. The company's debt level and interest expenses have undergone significant changes over the past year. According to the extracted summaries, the total debt has increased consistently across various reports. On page 40, it is noted that the debt level rose from $78,253 million in 2024 to $102,684 million in 2025. Similarly, on page 53, the debt increased from $66,313 million in 2024 to $85,919 million in 2025. Furthermore, page 82 reports an increase of approximately $24.5 billion in total debt from 2024 to 2025. In contrast, interest expenses have shown mixed results. On page 65, it is reported that interest expenses decreased from $2,931 million in 2024 to $2,848 million in 2025. However, on page 71, the opposite trend is observed, with interest expenses increasing from $2,899 million in 2024 to $2,793 million in 2025. The lack of significant change in interest expenses, noted on page 82, highlights the complexity of determining the impact of repurchase agreements on interest expenses. Overall, while there are some discrepancies in the data, it is clear that the company's debt level has increased significantly over the past year, with a notable rise in total debt from $63,989 in 2024 to $87,420 in 2025. The company's management is optimistic about its outlook and strategy, emphasizing the importance of stability and predictability in generating returns for shareholders. The focus on agency residential mortgage-backed securities, RMBS, and multifamily mortgage-backed securities suggests a commitment to long-term investment in a stable asset class. Management acknowledges that interest rate fluctuations pose a risk to net interest income and tangible net book value, but notes that they have implemented strategies to mitigate this risk through derivatives and active portfolio management. The company's liquidity and capital resources are also seen as sufficient to meet its obligations and execute its business strategy. The dividend policy aims to distribute 100% of taxable income, with a focus on generating favorable long-term returns for shareholders. Overall, the company appears to be well-positioned to navigate market fluctuations and achieve its financial objectives. The Federal Reserve's acquisitions and divestitures. The Federal Reserve has made several significant acquisitions and divestitures in recent years. On the acquisition side, the Fed has purchased agency RMBS through TBA dollar roll transactions, appreciated assets from a corporation not a REIT in a non-taxable transaction, and approximately $200 billion of agency MBS to lower mortgage rates and improve housing affordability. Additionally, the Fed acquired non-agency RMBS, CMBS, and CRT securities, as well as securities through repurchase agreements and U.S. Treasury securities through reverse repurchase transactions. In terms of divestitures, the Fed has reduced its agency RMBS holdings through prepayment runoff from $2.7 trillion to approximately $2.1 trillion as of December 31, 2025. The Fed may also have to dispose of acquired assets within 5 years to avoid tax on appreciation. Furthermore, if unable to qualify for exemption under the Investment Company Act, the Fed may be required to sell certain assets. That concludes the financial summary for Agnc Investment Corp. Feel free to comment below, and I will be happy to answer them when possible.